Hi there, students. Well, today we're going to tackle an interesting subject, and this is manually calculating your cost of goods sold and your ending inventory amount based on two different cost flow methods. So you'll see in your textbook and your practice work that the main two methods we're looking at here are FIFO, which stands for first in, first out, and the moving weighted average method. Now the moving weighted average method comes from the weighted average method, except if we're using the perpetual inventory system, there is a recalculation of the weighted average every time you buy new merchandise. So that makes it a moving weighted average. With FIFO, it doesn't matter which system you're using because it is simply first in, first out, meaning the last items you purchased make up ending inventory, and starting from your earliest cost from the year, those costs for whatever you sell make up cost of goods sold. So whether you're using the perpetual system or the periodic system, it really doesn't change under FIFO. Now, before we get going on this, I just want to give you a heads up that this is sort of picky, and it's not so much difficult, it's just a real bother to do. And we can all be happy today that for almost all businesses, a computer does this work for us. But just the same, you need to understand how these methods work, and almost all introductory accounting courses want you to make a chart or table of purchases and sales under each method, so that you can then calculate cost of goods sold for a period of time and calculate your ending inventory value. So it is a bit picky, and lucky for us, it's not really difficult, but it is kind of tedious. So bear with me in this video. We will go through a couple of examples here, and please stay tuned at the end. I have a couple of points to make about inventory in general. Now, if you really understand this, you might want to skip forward a bit, but let's go through this. So I've made up these tables in advance, and I'll just kind of explain how they work to you as we move along. So here are a set of transactions for us. So these are going to be transactions for the month of May for a hypothetical business. And first we're going to calculate inventory using first in, first out, called FIFO. Notice that we start with a beginning inventory. So whether this is January 1 to start a new year or the beginning of a month, as in this case, we always have a beginning inventory, which we're not buying, we just already have it. So let's have a look at how these work. So our beginning inventory is 1,000 units. Now I could have written $18.25 in here, but we often don't, just because we start with a total. So we have $18,250 worth of inventory. And the first thing we do here on May 3 above is we buy 200 units at $18.50. Now, one thing I've done in this example, I've assumed a period of rising costs. And if you're up to date on the rates of inflation all through North America for the last 6-7 years, you'll know that rising costs are pretty much the norm. So this would be how things work most of the time. And if you've been to the grocery store, you probably notice sometimes things go up 10 or 20% all at once. So I've done that here. We've gone up in price. So we buy 200 units at $18.50. So in our chart, I'll come back to the data every now and again, but in our chart, we can see that we purchase 200 at $18.50 and we extend the total. Now I've made these charts exactly the same as your textbook, just so that we don't get confused with different columns and so on. So with FIFO, we must keep track of the old cost as well as the new cost. So the old, I've drawn a line here. You can see we've got a line underneath. The old cost here is just typed in again. Our old cost simply from the line above gives us 18,250. The new cost we just copy over from here. Now, we have no total here, and we don't need a total, so we're not going to bother to put in a total. We're going to total things and figure things out at the end of the month. We don't need to do it as we go in FIFO. But these are the two things we have. 1,000 purchased originally for 18.25, which was our beginning inventory, and we have a new set of 200 units at 18.50. Now the next thing we do is on May 7, we sell 500 units. Now this is an inventory cost flow chart. It's not a sales journal. So we don't need to know the selling price. We're keeping track of cost of goods sold. And under FIFO, remember, called first in, first out, if you sell 500, you sold them out of this original 1,000. So your cost is based on the first ones you purchased, or $18.25. So this is the concept of first in, first out. And that usually follows the flow, the physical flow of inventory as well. So our cost then is 500 at 18.25. There's our total. Now we get to the inventory columns and we say, well, what do we have left? We have all of the most recent purchase, and we have 500 remaining of this initial 1,000. So 1,000 less the 500 sold is 500 remaining. You know, so at any time, if you get confused about where these numbers are coming from, you can always rewind the video a little bit and see where these numbers came from and how we calculated them. So according to FIFO, here's what we now have. We have 500 of the old units and 200 of the newer units. And then on May 10, we buy another 400. Now, you're going to get to see a pattern here, because here's what we now have. The price is higher. We have 500 of our oldest. We have 200 from the May 3 purchase, and we have 400 from the May 10 purchase, all at different prices. And here are the $3 amounts. Now, if you wanted to see your inventory balance at any point in time, you would just add these three numbers and you would have it. Now, we go ahead and we buy another 500 for $19.20 on May 13. So now we are keeping track of 4 different costs of inventory. 500 remaining from our original, 200 from May 3, 400 from the May 10 purchase, and 500 from the May 13 purchase. So you can see here how you have to keep track of so many of these. But sooner or later you're going to sell some. So we're going to sell some. When we sell them, you have to use the $18.25 cost items first, followed by the $18.50, followed by the $19. So we attribute cost, oldest cost first. Now, the transaction is sold 1,000 units. So when we sell 1,000 units, I'd like to show you that we don't just write 1,000. What we do, now these add up to 1,000, but what we do is we take 500 from the oldest cost here, and then 200 from the next oldest cost. There's these two lines that equal these two lines. Now that accounts for 700. We need 300 of these units from the May 10 purchase. So 300 of those lets us add up to 1,000. And here's what we have left. Now this is a blank line. You might think, oh no, a blank line. Here's what we have left. We've used up the 500, 200, and 300 of these. There were 400, we used up 300, we have 100 left at $19, and we have our most recent purchase, 500 at $19.20 left. So these make up our inventory at this point in time. And you can see that we have been selling our oldest cost items and keeping in inventory our higher cost. So we go and we buy another 300 units, and I think by now you'll be getting the idea of how this works. It's not too bad if you do it on Excel. If you have to do it by hand, it's a bit of like I said, a bother, but you can figure it out. So we buy 300 at $19.40. So we have 100 from before, 500 from the May 13 purchase, and 300 here from the May 20 purchase. Here's what we have for sale. And as we begin our last transaction, May 24, we're selling 500 units. And if you look at this, I bet by now you could predict which 500 units we're selling. First, we're going to our oldest 100, and we're selling those. And then we're selling 400 of these, our next oldest. So 100 at 19, corresponding to this, and 400 of the $19 and $20 items. Now, notice that's 400 of these. Here's what we're left with. We're left with 100, well actually it's here, it's 100 from the 500 purchase. So we're left with 100 there, 300 there, and here's what we're left with. Now, if we were continuing to buy or continuing to sell, I would just have more rows in this table. However, we don't, we're done. So we just look at the ending amount, and that's why these are just transcribed as is. These become the ending amount. So we have 400 units, and if we add these two numbers, our ending inventory under FIFO is $77.40. And if I want to know cost of goods sold, every time we were selling, we sort of extended this to a price. So what I've done here is I've added all of these different costs, and we get $37,230. Now, we need that amount for our income statement. So this goes directly to the income statement under cost of goods sold. This goes directly to the balance sheet, current asset inventory. So that's it for FIFO. Now, let's look at weighted average next. We're going to take the same beginning inventory and the same set of transactions, and we're just going to use the moving weighted average formulas. Now, in some ways, I would say this is easier for you if you're using Excel. If you're doing it by hand, it's actually harder. So if you have, a piece of paper and a calculator, it's going to be a little more difficult. But if you can use Excel, it's actually probably easily as quick, or maybe quicker than calculating FIFO. So here's our beginning inventory. And as we purchase 200 units, the price is higher. And wait a sec here. I'm on the wrong chart. Okay, that's better. So here's our beginning inventory, and we purchase 1,000 units. Sorry, I'm getting mixed up here. I'll fix it up. Okay, we had 1,000. Here's our beginning inventory. We buy the 200 at $18.50. Here's what we're going to do to calculate the weighted average. We're going to take the $3,700 that we just spent, and we're going to take the $18,250 that we had before, going to add those two costs together to get our total cost. And now we have a total of 1,200 units. So we're going to divide to find the average price per unit, which becomes $18.29 average price per unit. So here, unlike FIFO, where we list each item, so each price individually, we can just write 1,200 units at $18.29, our average price, and put in our amount. Now, don't worry, you may not notice, but this says 21,948 and this is 21,950, and that's because Excel is like rounding off a number in here. So a company that uses a computer might actually take this to 3 decimals, but for us, we don't have to worry about that a little bit. What we're going to do generally is just use the dollars and cents value. Okay, so let's look at the next thing that happens. So we sell 500. Now, we've decided that all of these units are valued at $18.29. So all we need to do is take 500 times 18.29, and there's our cost of goods sold. And we don't have 1,200 anymore. We have 1,200 minus 500, so we have 700 units. So our value now is 700 at 18.29 is 12,803. Now, the next 2 transactions under moving weighted average are both a purchase. But I'm going to show you kind of one at a time. So here's our May 10 purchase of 400 units at $19 for a cost of $7,600. So we want to find out the average cost. So here's the $7,600 we just spent, and we had this number, that number right there, 12,803. Here's our total cost, and we had 700 and bought 400, so now we have 1,100 units at an average cost of $18.55. So here's our 1,100 units at $18.55 for a total. Okay, now the next thing that happens is we go and we buy another 500. And these cost even more, giving us 96. So again, you know, if you have Excel, you can just do what I'm doing here on Excel. I can take this number that I had before, the 20,405. I can add the new purchase of 9,600 to get $30,000 altogether. And we used to have 1,100 units and we bought 500. So now we have 1,600 divided out, and we get 1875. So here is our moving weighted average price, $18.75 each. Now, we're going to go ahead and we're going to sell 1,000 units. So we used to have 1,600 units, and we just sold 1,000. So obviously we're going to have 600 units remaining at that average price of $18.75. And our cost of goods sold is really easy again. Because we have an average price, we just multiply units times our average price, and there's our cost of goods sold. Okay, 2 things left. We're going to buy some on May 20, and we're paying $19.40 for those. So here's what we have. We have this right here. This is our 600 units at $18.75 is $11,250. So there's our $11,250. And then we're going to buy 300. Now, I might have the wrong number here. This is right. Here's our 600 plus the 300. Now we have 900, and let's look at our average price. So we had 11,250. We spent 58.20 on these. There's our total. Here's our 900 units. 1897 is our new average cost. Now I just got a little mixed up there. You can see how easy it is to get mixed up in this because you're just tracking so many numbers at the same time. So all I can give you in advice here is take your time and just kind of carefully watch what you're doing and maybe let Excel do the math for you if you can do that. Okay, so we have 19 units worth $18.97 each, and there is our inventory value. Our last transaction is to sell 500. And you can tell already from our previous sales that this is the easiest part of using weighted average. We have an average price, we're just going to use it. 500 at $18.97 gives us our cost of goods sold. We have 400 left at $18.97 is $75.88. So let's look at what we have as we complete the month. Just as with FIFO up here, we have 2,000 units remaining. Your cost of goods sold is $37,380. Now, note that FIFO was $37,230 cost of goods sold, and that's because we keep using the earlier lesser cost to value a sale, the cost of goods. So because we keep using a lower cost in general under FIFO, our cost of goods sold is lower. Right here is weighted average, a little bit higher. Our ending inventory, this 2,000 was quantity sold. Here's our ending inventory of 400 with a value of $75.88. And the value is a little bit lower than FIFO because this is an average, whereas with FIFO, it's made up of our higher, newest cost. So you can see that the two methods give you, slightly different cost of goods sold and different ending inventory values. So before we finish this up, let's just make a couple of generalizations about how this works. In a period of rising prices, FIFO gives us a lower cost of goods sold and a higher ending inventory. I spelled that wrong. There we go, a higher ending inventory. Now, weighted average then, just the other way around. Spell anymore though. Okay, weighted average smooths these out, and it sort of averages everything, so you get a smoother average, and what we get is the opposite. We get a higher cost of goods sold and a lower ending inventory. Now, here's sort of an important concept for you, and even after you do all this work on inventory, I'm not certain if this concept occurs to every student. So let's look at this concept. And the concept is everything you paid for inventory, including your beginning inventory. So in our example, the 1,000 we had to begin with and all of the ones we bought is what we could have sold, right? So that's, if we take the beginning inventory plus all of the ones we purchased, that is actually a term called cost of goods available for sale. And that cost of goods available for sale is going to be split between two things only. So one number, $1 value, goes two places. Part of it will be cost of goods sold, and part of it will be ending inventory. And I'm going to show you. Here's a bit of a reprint from our FIFO example a little differently. Here's our beginning inventory valued at 18. And what I've done here is I've taken all our purchases plus beginning inventory, and this is what we have in inventory to spend or sell, $44,970. So that's beginning inventory plus all our purchases. This would be called cost of goods available for sale. Now, it has to go to one of two places. And I've just taken the numbers from the table above in FIFO and I've reproduced here. Here's what we calculated for cost of goods sold, and here's what we calculated for ending inventory. Notice the two add up to 44,970, just showing you the total cost of all your goods is split between cost of goods sold and ending inventory. So that's a way for you to check your work and also figure out, how much you purchased, how much you sold, and so on. And this should match all your accounting records. So I guess to wrap up this video, all I can say is I'm so happy that we have computers doing most of this. You may be asked to do this, a couple of times in homework questions or in an assignment. It's unlikely that you will have to do this in real life in your accounting career. So that's it for today. Goodbye.